Hey guys, welcome to Make Money Count. We have a few things to talk about. Marcus is really excited about it. So take it away.
Okay, so there's three things I want to talk about.
Okay.
Number one, the CPI number that came out.
Right. Everyone's excited about it.
Yeah. So CPI came in at 1.6.
Yep.
Everyone is saying that a big component is gasoline prices coming off.
Mm-hmm.
And sure, it's important.
Which has been welcomed by myself.
Yeah. I mean, that's a factor that Saudi Arabia has basically decided they can't hold off on producing oil in an effort to influence oil prices to be above $100 a barrel or around $100 a barrel.
It was like chicken.
They've stopped,
Right.
And partly probably because the guy's building the $2 trillion city that's a skyscraper that stretches 100 kilometers. Maybe it's more than 100 kilometers, actually.
Yeah.
And people need to get paid. And the issues in the Middle East have not forced oil prices to increase.
Right.
But I think that there's a bigger issue here, right? So I think that the Bank of Canada is seeing these inflation numbers come in and they're identifying that the economy's in trouble.
Right.
And we've been saying this for a while. Like, if you don't think we're going to get 50 basis points in October next week, you got another thing coming to you. In fact, we're probably going to get another 50 basis points in December.
Christmas gift.
Well, the problem is, and we talk about this a lot, right? Like, more interest rate cuts just means the economy's in worse shape.
Right.
Right? More interest rate cuts is, the Bank of Canada is trying to temper their behavior with not lighting the housing market on fire.
Right.
But there's no risk of that anymore.
Right.
Like, the housing market fire has been doused with water.
Right.
It doesn't even exist anymore.
Right.
Right? Like, it's like the logs are soaked.
Yeah.
It's going to take that stuff you use to start a fire. The fire starter?
What?
It's like the fire starter.
Oh, that's yeah.
So the economy is in very rough shape, and 50 basis points in October, 50 basis points in December, another 1.5 to 2 percentage points next year.
Next year, yeah.
And where does that leave us? At like a 3? Like, think about it, right? That's 3 percentage points. If it's 2 points next year, that's a 345 variable, 345 prime rate.
That's pre-COVID.
That's pre-COVID, yeah.
Yeah.
And that's where the level we were never going to get back to.
Right.
So if we get to that point, it means the economy's in real trouble.
Right.
And those CPI numbers, it's so frustrating. Like, do you remember my George Clooney comment?
Yeah. I was just thinking that in my head.
Central bankers should be like George Clooney with the joystick in the space movie where he's trying to get back.
And the farts.
Yeah. Psh. Where instead, like, how are we getting blindsided by this?
Yeah.
Like, target for CPI is 2. We're at 1.6, man. Like, you think October's going to be better? October's going to be just as abysmal.
Right.
Even with the rate drop. And now we're going to overcorrect to the downside.
Right.
Like, we're using monetary policy like this, like an oversteering. Like, you've never seen my kids play car games?
Okay.
But my kids love car games.
Right.
My 6-year-old plays car games, and the amount of oversteering that happens in that car game, like, he's never on the road.
Yeah.
This is like what's happening with our central bankers.
Yeah.
We just should be on the road. The goal should just be to stay on the road.
Mm-hmm.
See the turn coming up and keep the steering to a minimal, because it's very inefficient. It's very costly to be like steering all the time.
Yeah.
Nico finds new roads in the game.
I think we call those shortcuts.
They're not shortcuts, man. They're just like, he reaches a point in the game where the car just keeps banging up against like a blank wall of the horizon. Like that, like, eventually, if we keep causing the same problems, that's going to happen. I just want to say it's inefficient the way we're behaving as a central bank, as a federal government. Like, everything is manic.
Right.
Turn the taps on in immigration. Let millions of people in. Oh, turn them off now.
Yeah.
Add 50 basis points to the rate. Cut 50 basis points from the rate. Spend money like crazy to stop COVID. Okay, take all the money back out of the system. Like, you can't run an economy like this. And now, you know what we're going to be in now for the next little while? We're going to be in the other side of the manicness, right? Let's cut rates like crazy, stimulate the economy, bring the consumer back. We wouldn't have had to do this if we were just driving a little bit better in the video game that is monetary policy.
Yeah.
So my first thing I want to tell you was CPI numbers. Second thing I want to tell you is I read this article in the Globe and Mail that kind of pissed me off.
Okay.
And it was like, I don't know, maybe the banks wrote it. Like, maybe it was written for the Canadian consumer to choke down from the Canadian banks just so the Canadian banks could like
really give it to them?
Yeah, like I don't know who allows this stuff to come out, but it was in the Globe and Mail, and it said that fixed rates have reached their bottom.
Right.
Fuck off, right? Like who are you, right? Like, and it cites some quotes that aren't directly relevant to this bold title that fixed rates have reached their bottom. You know what, man? Fixed rates have not reached their bottom.
Mm-hmm.
They're not as low as they're gonna go.
Mm-hmm.
Okay. Because nobody knows how bad the economy is. And the expectation right now with a 1.6% CPI print is that we're going to see between 2.5 and 3 percentage points more in movement from the central bank.
Right.
And if you don't think that's going to translate into a lower Canadian bond yield
Of some sort,
that, like, I don't even know how you are working at a newspaper and producing an article.
Right.
Okay. And to tell Canadian consumers that, like, oh, now's the time you should be locking into a fixed rate mortgage. Fuck off.
It is totally the banks.
Yeah. Don't lock into a fixed rate mortgage right now.
Yeah.
Because fixed rate mortgages are going down.
Mm-hmm.
And if you're going to take a product right now, you take a variable rate mortgage because the variable rate mortgages are at prime -1 and they won't be prime -1 for very long.
Mm-hmm.
And eventually people are going to be clamoring for a prime -1 variable rate mortgage and they won't be able to find one.
Right.
The other thing I wanted to say.
Okay. We're whipping through these today.
Is I was on in Bloor West shopping for Thanksgiving, like for food for everyone coming over Saturday night. Not for you. I didn't buy anything.
For Christmas, yeah.
And my wife went in to get a coffee and is sitting outside. I have 3 boys, the experts at the car driving games.
Yeah.
I'm sitting outside with the 3 boys. And this is the first, I mean, you're going to be surprised when I tell you this. It's the first instance where my celebrity has really kind of come out.
Okay.
And this gentleman named Graham came over and he was like, hey, are you Marcus Aferis? I recognize your voice. I listened to your podcast on Spotify.
Interesting.
And I was like, oh my God.
We're famous. I mean, you're famous.
We're famous. I mean,
we're famous.
Whatever I am, you are.
Yeah.
And he's like, I listened to your podcast. It's really great. And he started referencing some of the things we had said. And he brought up a really good point.
Okay.
And he was like,
shout out, Graham.
Why do you get penalized when you personally want to shop for credit?
Right.
And they say that you don't. And, you know, Equifax likes to pretend that you don't. But he's right.
Mm-hmm.
It's a racket.
Mm-hmm.
Why aren't Canadian consumers allowed to freely seek credit? Why would it damage someone's credit score to have a whole bunch of hits, as many hits as you want on your credit profile? Like if I wanted to find the best rate on a credit card and everyone needed to check my credit rating, and I said, go for it. Unfettered access. Check it 1,000 times. I want to check out 1,000 different cards. I want to get them, I want to get the best rate to the 1,000th of a decimal point.
You want to get 21.98%.
Yeah. But like, why would I get penalized for that? Right?
Yeah.
Same thing like shopping for a mortgage. And at the moment, I didn't have an answer at the ready for him because I was so shocked that someone actually raised me from this podcast. Shout out, Graham. Thanks, man. But I'll tell you why. The Canadian banks have an agreement, like any oligopoly, to benefit themselves equally. And these agreements can only be forged over long periods of time and with a really, really great understanding of a marketplace. And the only time we saw it illustrated very, very clearly to us as a Canadian consumer was with the stress test.
Right.
I'll explain to you how this works, right?
Okay.
You probably know already.
Well, I know how the stress test works.
Well, what happened with the stress test was it was implemented by the federal government.
Right.
But the federal government was lobbied by the Canadian banks to implement it.
Right.
And they were lobbied at a time when shareholders were penalizing banks for increasing their mortgage portfolios.
Right.
So Canadian banks were faced with a challenge in 2009, right? Like the market had tanked, real estate prices were down, loan loss provisions were creeping up, and still loan loss provisions in Canada are like really an infinitesimal number.
Infinitesimal, is that a number?
Very small, very small. Yeah. But the Canadian banks had a problem because they were being penalized for increasing their mortgage books. So I think at the time, like Scotiabank had dumped $200 billion worth of mortgages into the Canadian mortgage bond program for portfolio insurance, which destroyed the portfolio insurance program and increased mortgage rates for everyone in Canada. Shout out Scotiabank. Shout out Bill Morneau, Minister of Finance at the time. Shout out Liberal government. And simultaneously, they were increasing their mortgage book because they had all this additional capital. And then the banks kind of got together and they said, listen, if we implement a stress test, it'll prevent customers from leaving my book and going to your book, right? Maybe there was one or two banks that strategically wanted to be more aggressive, but they all realized that they were being penalized by their shareholders and their stock prices for increasing their mortgage balances. So they were like, okay, I can get around that. So by imposing the stress test, they essentially placed a moratorium on transferring mortgages from one bank's book to another bank's book, right? Make it more difficult for people to jump books. And the least profitable piece of their mortgage portfolios is the new business because they're competing for the interest rates on it.
Yeah.
And the most profitable is the stuff that stays in the books.
Yeah.
So the banks, at a time of economic uncertainty, where the Canadian consumer was being battered, was overpaying for interest rates. That's the same time that the variable rate mortgages went from prime -1 to prime +1. 200 basis points of net interest margin spread. Okay. Canadian consumers already getting killed. The Canadian banks, in concert with the federal government, decide to stop mortgage shopping, implement the stress test, and thereby increase the net interest margins on all of their independent mortgage books by preventing their customers from shopping. We know it's telegraphed to us that Canadian banks do not want us shopping for our mortgages. They want us to stay exactly where we are, like good little boys and girls, accept what we are being given, say thank you and get a pat on the head, and like watch TV commercials of a green couch saying that it's more comfortable than we think, or we're richer than we think, or whatever asinine tagline we're being fed.
Right.
Well, who's to say that this Equifax scheme is any different? Justin wants to go shopping for a mortgage? How dare he?
Right.
He wants to go to 6 different possible mortgage lenders and look for the best rate? Fuck him. No, seriously. Let's prevent that from happening. Well, how are we going to do that, boss? I don't know. Let's deduct 5 points off his credit rating every single time he tries to go find a different mortgage. And we'll tell him that it's because he's a credit seeker and that increases risk. I bet you there is no correlation between someone who's effectively shopping for the lowest rate on a mortgage and someone who's going to default.
Right.
Right? It's not someone that's actively looking for the best interest rate that's going to do some harm to your debt, to their debt. This is the person that's going to have their debt pristine. Like we see it all the time. Like when we're lending on a private mortgage, do you ever want to lend to the guy that you, or the gal who you offer the mortgage rate to? And they say,
oh yeah, no problem.
Like they're not even listening. Like whatever the rate is, who cares?
Yeah. Send me the
in the back of their head, they're like, I'm not even going to pay this thing anyways.
Yeah.
It's not a good borrower.
Yeah.
A good borrower is the one that's going to beat you up on rate.
Yeah.
Are you sure that's the lowest rate? I mean, listen, you're always going to get the lowest rate from Cannect, but you want customers to have a vested interest in what the rate they're paying is. The Bank of Canada has said it to us. They've said it to the Canadian consumer. The Bank of Canada wants Canadians to use mortgage brokers and to actively shop their mortgages in order to receive the full benefit of monetary policy stimulus.
Right.
We're heading into a period of what I believe will be unprecedented monetary policy stimulus. Okay. And how are you going to get access to it? You're going to get access to it by having a variable rate mortgage, efficiently priced, and you're going to be fighting for that rate right now in this market because the banks don't want to give it to you.
Right.
The final thing I wanted to bring up is don't waste a good crisis.
Right. Yes, I was interested in this.
Okay.
Tell me more.
What do I mean by this?
Don't waste a good crisis.
TD Bank is in crisis.
For sure. They are in a crisis for sure.
I don't know if you remember, we did a podcast about this.
Yeah.
And at the time, TD Bank had issued their 10Q. They issued their quarterly report and they had taken a write down of like $400 or $500 million or maybe less for their exposure to issues relating to money laundering in the United States. And I said it's going to be way more. It's going to be billions of dollars. The final bill has come out. It's like $3 billion now. And they're getting barbecued for poor culture internally. Like emails of like, oh my God, like we're obviously the favored bank for money laundering.
I didn't see that.
Yeah, like there's a whole bunch of shitty stuff that's coming out. And it should have been obvious to people when the Justice Department started investigating them that this was going to be a serious penalty. It was going to be a serious punishment. In a year, no one's going to remember this. The only thing that people need to consider is this going to impact their ability to grow in the United States now?
Right.
Is there going to be some kind of handcuffing that takes place to prevent them from their expansive policies in the United States? Canadian banks are aggressive expanders in the United States because our home turf is so fertile for charging fees and doing whatever they want.
Mm-hmm.
But let's not let a good crisis go to waste. As a result, now in Canada, mortgage brokers are subject to FINTRAC regulations. Right. So very clearly, the horses ran out of the barn.
Mm-hmm.
They're nowhere to be found. There was no control over TD Bank. They were doing whatever they wanted. They got slapped by a U.S. regulator. They got slapped by the U.S. Justice Department. FINTRAC has also hit them with fines. I'm sure they're in the tens of millions of dollars. But now FINTRAC is going to start monitoring mortgage brokers, other mortgage lenders, and I am willing to wager that there is more regulation and more red tape coming. Listen, I think good actors are always going to be good actors. Bad actors are always going to be bad actors. But I think what it does do is this enhanced regulatory environment is going to add costs and it will reduce choice. And mortgage brokerages will stop being mortgage brokerages. And expenses will get too high and those expenses will get transferred over to the consumer. So I think that we're using a crisis to perhaps eliminate some of the bank's competition now.
Right.
And banks eliminate competition two ways, right? They either crush their peers or their competitors with regulations.
Mm-hmm.
So they lobby for those regulations and they crush them, or they buy them.
Right.
And like a year ago, we started hearing about banks venturing in and acquiring
mortgage brokerages.
Yeah.
Yeah.
And I think we're going to see both of these strategies play out. Acquisitions and crush with regulations. They did it with trust companies. Like TD Canada Trust became TD Canada Trust because trust companies came into the market and started aggressively discounting mortgages. And with their aggressive discount of mortgages, the banks had a decision to make. Are we going to allow ourselves to lose net interest margin is like the holy grail for banks, right?
Yeah.
Banks want to just make money on net interest margin. The difference between the amount of money that the bank pays their deposit holders and the amount of money that the bank charges to the people that borrow money from it. Holy grail. Well, when the trust companies came in the 80s, they started aggressively discounting mortgage rates. The banks were like, oh my God, what are we going to do with these guys? They couldn't crush them with regulations. So they bought them all up. They spent the money to buy them up, eliminated their competition, and then interest rates for mortgages just skyrocketed again. And then mortgage brokers came onto the scene, rate competition came in again. I would just listen, when you're looking for your mortgage, you're going to get the best rate from a mortgage broker, and then your bank is going to match it. And you can be one of two types of people. You can either be the person that spends the time with the mortgage broker and takes the information from the mortgage broker and befriends the mortgage broker and executes a deal with the mortgage broker, or you could be a prick. No, I'm just kidding. But you're not doing a real service to anybody if you work with a mortgage broker to get the best rate on the market, and then go back to your bank and have your bank match that interest rate and then end up sticking with your bank. Because if you do that, you really are playing into your bank's hand, because your bank understands that if everybody did that, there would be no more mortgage brokers. And if there were no more mortgage brokers, there'd be no more discounted interest rates.
Mm-hmm. So
this really is an example of like, be a good person if you want this market to continue to exist, right? Mm-hmm. Not necessarily for our business, but like I speak to other mortgage brokers who right now, when you talk to them, they're kind of discouraged, right? Because they are working hard. Banks are sending renewal offers out. The renewal offers suck.
They're last minute.
Yeah. They send them at the last minute and they suck. Then they'll call a mortgage broker, and a well-informed mortgage broker will say like, listen, you don't have to sign that. I can get you a way better rate. They'll give them the interest rate. They'll work on the deal. They'll spend countless hours on it. And then that customer will end up just going back to the bank and saying like, oh, well, my bank kind of came pretty close to the rate and
it's a lot of work.
Yeah.
Which it's not.
I get it. I feel for the consumer. I understand that, it's change and the bank is relying on that. They're preying on the fact that you don't want to have to deal with that change. But just think about it, right? Like the person that's doing that work for you doesn't really make anything until that work is done. I mean, Cannect is different. You can waste everyone's time at Cannect and none of them will really care. It will only be me that will be bothered by it, because I'll notice that we're working on all kinds of deals and none of them are closing because people are taking our rates and shopping them at the banks. It's okay though. I want Canadians to get the best interest rate on their mortgage, right? But ideally, if you're doing this, stick with the one who brung you, right? You're getting a great rate. You're getting the thing that you wanted. Identify the thing that you want, achieve the thing that you want, and execute upon it. Don't waver and go back to your other date that didn't really want you at the beginning anyways.
Stick with the one who brung you.
Yeah.
This was a great podcast. I do want to point out that you missed a very good opportunity because I know you like comparisons, analogies, that the bank is playing the game where they're driving the car, but they're going around and they're smashing everyone else's controllers and taking their controllers so they can drive a few cars at the same time. Is that a good one?
I thought you were going to go somewhere like absolutely genius, but you went somewhere where I don't fully understand. Okay, can you try to explain it to me again? The central bank?
No, we're talking about the banks.
Oh, okay.
'Cause we're talking about either crush
right. Okay.
or absorb.
So how, okay.
So there's a bunch of mortgage brokers and banks, and they're all playing the game. And the banks are going around and picking up the controllers, and they're smashing them on the ground, or they're taking them for themselves.
And they're playing the game flawlessly.
Yeah. And they're playing it so good.
Top score.
And nobody else can play anymore because they lost their controllers.
Yes.
Missed opportunity.
You know what I thought you were going to go with it?
What?
Is that maybe the central bank is playing the game like Nico, like haphazardly, on purpose to create volatility, to create profitability.
Right.
For the banks.
Right.
That would be like the ultimate stroke of evil genius.
Right.
Volatility creates wealth.
Right.
Static upward trends make wealth for everybody.
Yeah.
Volatility creates great wealth for certain people.
For one of those who understand.
So, I mean, that would be really mean though.
Yeah. It's not like government would do something like that.
I mean, wouldn't be the government in this case.
Well, yeah.
It would be like
the lobbyists.
Some guy in Davos.
Yeah.
Okay. Thank you very much. Remember, don't like it and don't subscribe. We love you. Thanks a lot for watching. Shout out to Graham for stopping me on the street.
Thanks, Graham.
That made me feel really cool. And my kids were like talking about it all Thanksgiving. Like we'd go to someone's house, or like my mom came over for dinner, and Theo, my 8-year-old, was like, Nonna, do you know that somebody recognized Daddy from his podcast?
That's so cute.
On that note, thank you.